Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
Hey guys, there is a fund on the TSX that's been paying Canadian monthly income since 1997. Through the dot-com crash, the financial crisis, a pandemic, and one of the fastest rate hiking cycle in history. It's not an index fund, it's not a single stock, and most investors have never heard of it. It is called Canoe EIT Income Fund, ticker EIT.UN. Today, I'm telling you why this is the one holding I will put into my TFSA and never touch it again. Exactly how it generates that income, what the numbers actually show, and where the real risks are hiding. EIT is a closed-end investment trust managed by Canoe Financial and co-managed by Haber Trelix Advisors. That structure matters. Unlike a normal ETF that creates and redeems units daily based on demand, a closed-end fund trades a fixed pool of capital on the exchange. That means the managers aren't forced to sell good holdings just because investors are pulling money out of in panic. The fund's actual mandate, in its own word, is to maximize monthly distribution relative to risk while maintaining and expanding net asset value. That's the whole game. Income and capital preservation, not one at the expense of the other. This isn't a new product chasing a trend. Under this general structure, formerly Enervest Diversified Income Trust, it's been through nearly 3 full decades of market cycles. Here's the part most just by the yield video skips entirely. Where does a 7% distribution actually come from when the underlying holding only yields 3 to 4% on average? The honest answer is that EIT isn't a pure income fund, it's a total return fund that engineers its monthly payout from 3 sources. First, dividend and interest income from the portfolio, roughly 3.2% of the total. Second, realized capital gains from active trading of the holdings. The managers buy and sell within the portfolio, and profitable trades get distributed alongside the dividend income, adding another 2.5% or so. A third, a modest slice of the return of capital handed back to unit holder to keep the monthly payment steady, particularly in periods when gains are harder to realize, contributing to the remaining 1.3%. Add it up and you get the roughly 7% annualized distribution, but it is built from 3 different ingredients, not one. And what's the actual inside the fund backing that up? A diversified, actively traded basket, roughly 30% Canadian energy major, the single largest sector weight, around 20% financial and big banks across Canada and the US, 15% healthcare leaders, and 18% fixed income sleeve for ballast, and the remaining 17% spread across other Canadian and US dividend pairs. This isn't a static index. The managers are actively rotating this basket, which is exactly how they generate the capital gains layer of the distribution. Knowing this matters for one big reason: a fund that pays out more than its holding yield isn't automatically a red flag, but it does mean the sustainability of the payout depends upon the manager continuing to trade well, not just on the dividend showing up on the autopilot. EIT pays 10 cents per unit every single month, no matter what the market is doing. Annualized, that's $1.20 per unit. And at a recent price around $17 to $18, that works out to be yield around 7% range. Now, here's the number that actually separates this fund from most of the high yield names flooding the TSX right now. EIT payout ratio sits around 33%. Given what we just walked through, dividend income, capital gains, and return of capital all feeding the same monthly payment, a 33% payout ratio means the fund is distributing roughly a third of what it earns across all 3 of these sources combined. That leaves enormous room for the distribution to be sustainable through a downturn without the managers needing to lean harder on return of capital or cut the payment outright. Compare that to a lot of newer yield maximizer and covered call products paying 11, 15, or 20%. Those numbers often comes with the payout ratio well north of 100%, meaning the fund is returning more than it earns and slowly eating its own NAV value. EIT isn't playing that game. Income is only half the story. A fund that pays a great yield but bleeds unit value every year isn't a never sell. It's a slow leak. So let's check the other half. Over the past year, EIT 52-week range ran from $15 up to 17.95 cents. And as early August 2026, it is trading right near those highs. That's not a fund quietly eroding in the background while the yield distracts you. The unit price has actually been appreciating along the distributions. That combination, a well-covered payout and NAV that's holding or growing, exactly what you want from forever hold. It means the fund isn't sacrificing tomorrow's capital to pay today's income, which ties directly back to the capital gains engine we just covered. When the trading strategy works, both the distribution and NAV benefit at the same time. Two reasons this pairs so well with TFSA. First, monthly cash flow, tax-free forever. A 7% yield sounds good on paper, but remember that distribution is a blend of dividend income, capital gains, and return of capital. In a taxable account, the mix complicates your tax return every single year. Each component gets taxed differently. Inside a TFSA, none of that matters. Every one of these 12 payments a year lands in your account untouched, regardless of how the underlying mix shifts from one month to another. Second, the closed end structure protects the compounding because the fund isn't forced to liquidate holding to meet a redemption during a market panic. Long-term unit holders aren't punished by other investors' short-term fear. That's the structural advantage most ETF don't have. It is a big part of why this fund has survived and grown for almost 3 decades. Reinvest those monthly distributions through a drip, and you are compounding a 7% yield tax-free monthly inside an account that never sends you a tax slip. No forever hold is risk-free. Here's what to actually watch. Discount to NAV risk. Closed-end funds can trade at a premium or discount to their underlying net asset value, driven purely by investors' sentiment rather than fund performance. If EIT ever trade at a wide discount, that's not necessarily a reason to sell. It can actually time to buy. But it's dynamic that doesn't exist with the standard index ETF. Preferred unit leverage. The fund has issued preferred units to raise capital. That's the modest form of leverage on the balance sheet. It is not aggressive 25 to 33% leverage you see in some Hamilton or Evolve income products. But it's not zero either. Active management risk. Remember that capital gains engine funding roughly a third of the distribution. That's only work if the manager keep trading well. A change in strategy, team, or stretch of poor call could shift the fund's character and put more pressure on the return of capital component. 28 years of history is reassuring, but it's not guarantee. Same rule as always. Never sell means the thesis is durable, diversified holding, a conservative payout ratio, a structure built to survive panics. Not that you should stop paying attention entirely. So, is Canoe EIT Income Fund really a never sell? Out of everything I have reviewed for this channel, high leverage, yield maximizer, single sector cover call ETF, zero DT income for our products, this is the one built the way forever hold should be. A transparent 3-part income engine, a sustainable payout ratio, a resilient NAV, and nearly 3 decades of proof it can survive whatever the market throws at it. If you want to see how EIT.UN stacks up directly against the high yield covered call names we have covered, for example, HTIV, HYLD, HMAX, and the rest, that comparison is coming next. Thanks guys for watching this video. See you in the next one.